Welcome to the Explainer. Look, Germany's DAX index is at a really interesting point right now. So today, we're going to unpack a forecast that looks ahead to 2025. We'll explore the good, the bad, and the most likely scenarios, and then we'll dig into the data to see what's really going on.
So let's just jump right into it. The big question on everyone's mind, especially if you're watching the German market, is pretty simple. Where's the DAX actually headed?
And to figure that out, here's how we're going to break it down. First, we'll look at the three big potential futures. Then we'll get into the key signals and levels you should be watching. After that, we'll see what a data-driven simulation tells us. And finally, we'll talk about how to navigate all the risks involved.
Okay, first up, the three potential futures. You can think of these as the main weather forecasts for the market. Are we in for blue skies, just a few clouds, or is there a storm brewing? All right, the most likely scenario, what we call the base case, puts the DAX right around the 24,000-point mark by the end of 2025. Think of this as the steady, middle-of-the-road pass.
Now, what's really interesting is that the analysis gives this a 50% probability. Yeah, a coin flip. That means right now, this single outcome is seen as just as likely as every other possibility combined. It's definitely the front runner.
So what has to happen for this base case to play out? Well, nothing too crazy, actually. It's all about a steady, drama-free environment. We're talking a gradual recovery in European consumption, exports staying stable or growing just a little bit, and the European Central Bank, the ECB, just keeping a steady hand on the tiller. Okay, now let's talk about the good stuff, the optimistic outlook, the bull case. In this much sunnier world, the target is an ambitious 26,000 points. But what are the chances of this actually happening? Well, the analysis gives it a 25% probability. So it's a real possibility for sure, but it's definitely not a slam dunk. And here's the thing, for this bull case to become reality, a whole bunch of things have to go just right. It's like the stars have to align. You need a big recovery in global demand, especially from the US and China. You need the ECB to keep things accommodative, and you need a weaker euro to give those German exports a nice boost. All right, now we have to look at the other side of the coin, the stormy forecast, the bear case. If things go south, the DAX could face a pretty serious correction, maybe falling all the way back to the 20,000-point level. And get this, in this forecast, the pessimistic scenario is seen as just as likely as the optimistic one. Yep, it also gets a 25% probability. So what are the triggers for this? The main risks are external shocks, stuff that could completely derail the economy. We're talking about things like global demand suddenly getting worse, new geopolitical tensions flaring up, or an unexpected spike in inflation or energy costs. The kind of thing that forces central banks to hit the brakes. So here it all is, laid out side by side. You can really see the symmetry, right? The base case is sitting there at 50%, with the bull and the bear cases each getting a 25% slice of the pie. It really feels like the market is balanced on a knife's edge between steady, predictable growth and some pretty big potential shocks. Okay, so we've got three different paths ahead. The big question is, how do we know which one we're actually walking down? Well, that brings us to our next section. Let's pull out the map and look for the key signposts. First off, let's talk about a support level. What is it? Just think of it like a safety net or a price floor. It's a point where a whole bunch of buyers tend to jump in and say, nope, not going any lower, which can stop a downtrend in its tracks. And the opposite of that, of course, is resistance. This is like a ceiling. It's a price level where sellers usually show up in force, making it really tough for the market to break through and keep climbing. So with that in mind, here are the specific numbers you want to keep an eye on. These are the key floors and ceilings. Think of them like tripwires. If we see a decisive break below 22,000, that could be the signal that we're heading towards the bear case. On the flip side, if we can power through 24,800, that could be the fuel we need to make a run for that 26,000 bull target. And it's not just about the price levels. You also need to watch the road conditions, so to speak, the economic data. We're talking quarterly results from big players like Siemens and SAP, German export and industrial numbers, and of course, what the ECB decides to do with interest rates. Any of these could be the trigger that tells us the forecast is changing. Okay, so those three scenarios give us a really solid framework. But what if we could go even deeper? What if, instead of just three paths, we could simulate thousands of possible futures? Well, we can. That's exactly what a pretty cool tool called a Monte Carlo simulation lets us do. Take a look at this. Each one of these squiggly lines represents one possible journey for the DAX by the end of the year. This is just 100 simulations, but you can already see the huge range of possibilities. Some go up, some go down, but they all kind of dance around a central path. It's a great way to visualize just how uncertain the market really is. But what happens when we run this thing 10,000 times? Well, a much clearer picture starts to form. This distribution shows where the DAX is most likely to end up. And look at that. The peak, the most frequent outcome, lands right around 23,300. That is incredibly close to our base case scenario of 24,000, which is pretty validating.
And the great thing is, we can pull some very specific numbers out of this data. The simulation tells us there's about a 32% chance of the DAX rallying above 24,000, but it also highlights a 17% chance of it dropping below that key 22,000 support level. So that's definitely a risk to keep on the radar.
So, what do you do with all this information? How do you actually apply it? Well, the source material suggests a few practical steps for managing your risk. First, maybe think about sizing your positions according to these scenarios. Second, use dynamic stop losses below those key support levels we talked about, like 23,200 and 22,000. And third, if you have long-term positions, it might be worth considering some hedging strategies, like put options, to protect against that bear case.
So, we've looked at the big picture forecasts, we've mapped out the key levels to watch, and we've even run the numbers through thousands of simulations. It all comes down to this one final question. The data shows us the probabilities, but which story will the market actually write by the end of 2025?